2008, the global economy did not just crash, it was hours away from total collapse. Banks stopped trusting each other. Companies could not pay their workers, and trillions of dollars simply vanished. Then came the moment nobody expected. They let a bank fail. Not a small bank, not a struggling institution. They let Lehman Brothers collapse. A 158-year-old bank that had survived the Civil War, 2 world wars, the Great Depression, the dot-com crash, gone overnight. Within 72 hours, the entire global financial system was on the edge of complete destruction. Stock markets fell simultaneously around the world. Credit markets froze. Banks stopped lending to each other because nobody knew which institution would be next. By the time it was over, $19 trillion in household wealth had been erased. More than 8 million Americans lost their jobs. Millions of families lost their homes. It did not start on Wall Street. It started in the living rooms of ordinary American families who had one simple dream. They wanted to own a home. The year is 2002. The imposing Federal Reserve building in Washington, D.C., shot with dramatic architecture emphasizing its institutional power. The camera slowly zooms in on the building's facade. The lighting is authoritative and serious, with strong directional light creating defined shadows. The Federal Reserve has cut interest rates to 1%, the lowest in 45 years. Borrowing money has never been cheaper in living memory. A bustling real estate office with agents on phones, sold signs being prepared, and happy families signing documents. The activity level is high and energetic. The lighting is bright and optimistic, suggesting prosperity and opportunity. Low rates mean low mortgage rates. More people can afford homes. Prices start rising. And people begin to believe something dangerous, that housing prices would never go down. Banks notice the demand. Competition for mortgage customers becomes intense. A bank loan officer stamping "approved" on a mortgage application. The paperwork shows clearly inadequate income figures. The officer's expression is indifferent, focused only on processing volume. The lighting is clinical and cold, emphasizing the mechanical nature of the approval process. In one documented case, a man earning $14,000 a year was approved for a $724,000 mortgage. The loan was approved. Because the lender had no intention of keeping it, banks had discovered something powerful. They did not need to hold the loans. They could sell them. Thousands of mortgages were bundled into financial products called mortgage-backed securities, sold to investors around the world. Then Wall Street made things even more complex. They created instruments called collateralized debt obligations, CDOs, layers of mortgages bundled on top of mortgages. And rating agencies gave many of these products AAA ratings, the same rating given to United States government bonds. But they were not safe. They were built on one single assumption, that housing prices would always rise. Nobody seriously asked what would happen if they did not. By 2006, the cracks began to show. Housing prices slowed, then fell. Subprime borrowers whose adjustable rate mortgages were resetting to higher payments began defaulting. Month after month, more foreclosures. The bare Stearns building with news crews gathered outside suggesting crisis. The lighting is dramatic and news-like, with harsh camera lights cutting through darker surroundings. In June 2007, 2 major hedge funds at Bear Stearns collapsed, completely wiped out by their exposure to mortgage-backed securities. The warning was clear. News footage-style shot of JP Morgan Chase executives announcing the Bear Stearns acquisition. The lighting is formal and corporate, suggesting official business proceedings. By March 2008, Bear Stearns itself was failing. JP Morgan Chase acquired it for $2 per share, a company that had been trading at $170 per share just 1 year earlier. Government officials in a crisis meeting room suggesting emergency intervention. The lighting is serious and institutional, emphasizing the gravity of the situation. The government rescued Bear Stearns, and in doing so sent a message that major banks would always be saved. That message would prove dangerously wrong. Then came September 15, 2008. The government did not rescue Lehman Brothers. It filed for bankruptcy, the largest in American history. $600 billion in assets, gone overnight. Multiple trading floors around the world in complete chaos. Traders shouting, phones ringing constantly, red numbers cascading down screens. The lighting is frantic and harsh, emphasizing the panic. Panic spread instantly and globally. Banks stopped lending to each other. The commercial paper market, through which companies borrow money to pay wages and buy supplies, froze completely. Companies that had nothing to do with mortgages suddenly could not access the cash they needed to operate. Financial news displays showing money market fund losses, with worried investors on phones checking their accounts. The lighting is clinical and cold, emphasizing the systematic nature of the crisis. The Reserve Primary Fund, a money market account considered one of the safest investments in America, announced it had lost money. Investors began withdrawing from money market funds across the entire system in a panic. A conceptual shot showing the interconnected nature of the financial system, perhaps through network-style graphics or multiple bank buildings. The lighting is dramatic and ominous, suggesting systemic failure. The global financial system was not experiencing a bank run on one institution. It was experiencing a bank run on everything simultaneously. Governments had no choice but to intervene at unprecedented scale. The Federal Reserve made emergency loans under powers not used since the 1930s. Congressional session with lawmakers voting on emergency legislation. Congress passed the Troubled Asset Relief Program, TARP, authorizing $700 billion to stabilize the banking system. The government took ownership stakes in Citigroup and Bank of America. It nationalized Fannie Mae and Freddie Mac. The recession that followed was the deepest since the Great Depression. Unemployment rose to 10% in America. In Spain and Greece it reached 25%. And the people most responsible for building the system that caused this largely kept their wealth and their freedom. No senior Wall Street executive went to prison. The 2008 crisis was not random. It came from three things every person managing money needs to understand. First, incentives determine behavior more than rules or ethics. When mortgage originators were rewarded for volume, not quality, they produced volume regardless of quality. Second, complexity hides risk rather than eliminating it. When a financial product is too complex to explain simply, that complexity is almost always serving someone else's interests, not yours. Third, the most dangerous words in finance are, "This time it is different." Every major financial crisis in history has been preceded by the belief that old rules no longer apply. They always apply. In September 2008, a 158-year-old bank disappeared in a single weekend. The financial system, built on the assumption that housing prices would always rise, collapsed in weeks. And the consequences reshaped the lives of hundreds of millions of people who had never heard of a collateralized debt obligation. The system was not broken by accident. It was built in a way that allowed this outcome to become inevitable. Understanding it today is the only protection against it happening to you. If this documentary changed the way you see the financial system, hit that like button and subscribe to Gold Coast Money. Every week we go deep into the real economics behind the world's most important financial events, based on facts, based on data. I will see you in the next one.